Welcome back to the deep dive. We are doing something a little different today. Usually we're tracking ideas or, trends, but today we are tracking a collision. We're looking at the exact moment in the 1980s when Wall Street, corporate ego, and just a staggering amount of debt all crashed into each other.
Yeah.
We are talking about the deal of the century, the fall of RJR Nabisco.
It is a story that, it really defined a decade. You have this massive conglomerate, a $25 billion battle for control, and a cast of characters that honestly feels like it was written for fiction.
Right.
And to guide us, we're using the definitive account of that chaos, Barbarians at the Gate by Brian Burrow and John Halliar.
It is the book that terrified every CEO in America.
Oh, it really is. It's the Bible of high finance drama.
And to keep us grounded in what actually happened, because it does get a little surreal, we're going to organize this around a set of specific visuals. Think of it like a mental slide deck.
Yeah.
We're going to walk through the rise of this corporate empire, the excess that rotted it from the inside, and the financial war that tore it apart. So I want you to imagine the lights are dimming, the projector is humming, and we are clicking to the first slide.
Let's see it.
Okay, slide 1. We are starting right with the definition of the weapon used in this war. On the screen, you've got the cover of the book, that striking red and black design. But next to it, I want you to picture a quote from the comedian Jackie Mason.
Jackie Mason, yes.
He famously said, "This is a business for people who don't have money." He says, if you don't have the cash, you need to bring it by Thursday. But if it's an LBO, nobody knows where they got it from.
He's basically the accidental financial analyst.
Yeah.
He is identifying the core mechanic of the leveraged buyout, or LBO.
It captures the absurdity of it so perfectly. He says you need more money to open a shoe shine shop than to buy a $2 billion company. But let's move past the joke. Mechanically, how is that possible? How do you buy a giant company with, no money?
Well, the no money part is a little bit of a stretch, but only slightly. In an LBO, you are buying a company using a tiny, tiny sliver of your own cash, that's the equity, and a massive mountain of borrowed money, debt.
Okay.
It's sort of like buying a house with a 1% down payment and a 99% mortgage.
But with a house, I have to pay the mortgage out of my own salary. If I buy a corporation, who's paying that mortgage?
The house pays for itself. That is the magic trick here.
Ah.
You use the company's own future cash flow to pay back the debt you used to buy it. You are, in effect, using the company's credit card to purchase the company.
That sounds incredibly risky.
It is. It's high risk, high reward.
Mm-hmm.
And in the 1980s, this tool allowed a new breed of aggressive investors to topple these old-school corporate stewards.
Right.
It replaced the company man with the non-company man. You didn't need to know how to bake cookies. You needed to know how to structure debt.
And that brings us to the man at the center of our story, Ross Johnson.
Ross Johnson. The man who decided running the company wasn't enough. He wanted to own it.
But before we get to the deal that blew everything up, we have to understand the mess he was presiding over. So let's click to slide 2.
The Unnatural Union.
And the visual here is pretty striking. It's an Oreo cookie just violently colliding with a pack of Camel cigarettes. And the caption reads, "Mom and apple pie meet the skull and crossbones."
That really sums up the merger between Nabisco and R.J. Reynolds in 1985.
Yeah.
You have to understand, these were two completely different worlds.
It just raises the strategic question, though. Why on earth did a tobacco company merge with a cookie company? It seems like a brand nightmare.
It was a nightmare for the brand, sure, but it was a necessity for the balance sheet. You have to look at R.J. Reynolds in the mid-'80s. They were a cash machine. Tobacco was incredibly profitable, but it was facing an existential threat: liability lawsuits. The CEO at the time, Tylee Wilson, was terrified that one day a gavel would bang in a courtroom and the company would just be bankrupt.
So he needed a lifeboat.
He needed diversification. He needed a business that was safe, something lawsuits couldn't touch. And what is safer than cookies and crackers?
Yeah.
So Reynolds acquired Nabisco for $4.9 billion.
Creating the 19th largest industrial company in America. But while the balance sheet might have looked safer, the culture was immediately toxic.
Oh, it was oil and water. The book paints this incredible picture of the clash. You had the Nabisco executives in New Jersey described as stolid bakers.
Right.
Conservative, quiet, early to bed. And then you have the Reynolds guys down in Winston-Salem, North Carolina.
The death merchants.
That is what they were called. And to make it even more complicated, the Nabisco team also included executives from a previous merger with Standard Brands. Those guys were known as the booze boys.
The booze boys.
Yeah, they came from the liquor business. So you have bakers, booze boys, and tobacconists all trying to share an office.
And sharing elevators, which apparently was a literal battleground.
Oh, it was so petty. The source mentions legitimate fights over smoking in the elevators. The Nabisco people were horrified. But it went deeper than just annoyance. It was, a moral conflict.
There's that detail about the margarine. Nabisco owned Fleischmann's margarine.
Right. So shortly after the merger, Ed Horrigan, the hard-nosed tobacco chief, finds out that Fleischmann's is running a marketing campaign with the Heart Association urging people not to smoke.
Oh my God. You can see the problem. One division of the company is paying for ads that tell the public the other division is killing them.
Horrigan hit the roof. It paralyzed the company. It was, just as the slide says, an unnatural union.
And sitting atop this chaotic pile was Tylee Wilson, the Reynolds CEO. But not for long. Let's move to slide 3, the coup.
The visual here is a chess piece, a king being toppled over. This is the story of how Ross Johnson, who came from the Nabisco side, took out Tylee Wilson.
And it is such a study in contrasting leadership styles. Wilson sounds like the classic corporate steward.
He was. Tylee Wilson was cautious, process-oriented. He wanted to be the hero of a Harvard Business School case study. He loved 5-year plans. He loved charts.
And Ross Johnson,
the ultimate non-company man. He was charismatic, chaotic, and he absolutely hated planning. He had this famous line about it. Planning is just, what are you going to do next year that's different from what you did this year?
So you have the planner versus the player. How does the chaotic guy take down the careful guy? Usually in a corporation, process wins.
Johnson used a wedge, a very expensive wedge called Premier.
The smokeless cigarette project.
Exactly. It was supposed to be the savior of the Jacko industry, but the technology wasn't working and the costs were just spiraling out of control. And Wilson, being the careful steward, was trying to hide the cost overruns from the board of directors.
Which is a dangerous game to play.
Extremely. And Ross Johnson saw an opening. While Wilson was burying his head in engineering reports, Johnson was working the room.
This is boardroom politics 101. He didn't go to war with guns. He went with dinner parties.
Precisely. Johnson was a master charmer. He courted the board members, heavy hitters like Paul Schick and Charlie Hugel. He gave them perks, consulting contracts. He made them feel like they were the ones running the show.
He built an alliance right under Wilson's nose.
He did. And in August 1986, the trap sprung.
It was brutal, right?
Wilson walked into a board meeting thinking he was in charge. By the time he walked out, he was retired. The board he thought he controlled had completely turned on him.
Wilson's quote, looking back, is just so resigned. He just said, well, they got me.
Simple as that. He walked away with a golden parachute of $3.25 million, and Ross Johnson was crowned the undisputed CEO of RJR Nabisco.
So now the non-company man is running the show. And you might think, okay, he won, now he's going to streamline things, but that is not what happened.
Not even close.
Let's look at slide 4. The title is The RJR Air Force and the Image. It's a gold-plated Gulfstream jet. We need to talk about how Ross Johnson spent money because it's almost hard to believe.
This is the era of excess defined. Let's start with the hangar. Calling it a hangar is an insult. It was the Taj Mahal of aviation. They built a flight facility in Atlanta that cost $12 million.
$12 million in 1980s dollars.
Right. It had inlaid mahogany floors, a 3-story atrium. It even had antique Chinese robes on display in the lobby.
In an airplane hangar, who is wearing antique robes to a flight?
It wasn't about wearing them. It was about showing that you could have them. It was a monument to corporate ego. And the fleet inside was just as absurd. They had 10 corporate jets.
Man!
Yeah, including G4s that were worth $21 million each. Johnson treated them like personal taxis.
The source mentions his German shepherd, Rocco.
Rocco. There are flight logs of the jet moving around with just Rocco and a security guard on board. The dog had better travel perks than 99% of the shareholders.
And it wasn't just planes, it was people. We have to talk about Team Nabisco. This is the celebrity payroll listed on the slide.
Johnson just loved being around fame, so he put athletes and celebrities on the company payroll for consulting. You had O.J. Simpson getting $250,000 a year.
And what was he advising on cookie marketing strategies?
The source notes, he was a perennial no-show at company events. He was just getting paid to be O.J. Simpson. Jack Nicklaus, the golfer, was getting $1 million. Frank Gifford, it was a party funded by tobacco profits.
And Johnson's philosophy on the spending is chilling. The quote on the slide says it all. A few $1,000,000 are lost in the sands of time.
That quote really encapsulates the agency problem.
Unpack that for us.
Well, the agency problem is the conflict of interest in any corporation. You have the principals, the shareholders who own the company, and the agents, the managers like Johnson who run it. The agents are supposed to work for the principals.
Right.
But Johnson wasn't working for the shareholders. He was working for Ross Johnson. He was spending their money to fund his lifestyle.
But here is the rub. While he is living like a king in Atlanta, having moved the headquarters there just because he liked it better, the stock price wasn't moving.
And that drove him crazy. The food business was booming. The tobacco business was a cash cow. But the stock was trading at a discount because the market just saw tobacco lawsuit risk.
So Johnson is rich, powerful, has an air force, but he feels unappreciated.
And that frustration is the trigger. He thinks, if the market doesn't appreciate this company, I will just buy it myself. He decides to launch an LBO to take the company private.
He wants to be answerable to no one, just Ross and his jets. But he makes a critical calculation error here.
He does. He thinks he has the board in his pocket.
Yeah.
Remember, these are the guys he charmed. He assumes they'll just rubber stamp his deal. So he proposes a buyout at $75 a share.
Which was higher than the current price, but still.
It was a lowball.
Yeah.
A massive lowball. And this is where the stolid board members suddenly woke up. They realized their fiduciary duty. They can't just hand the company to the CEO for a bargain.
They have to put it up for auction. And once the for sale sign goes up on a company this big,
the sharks smell blood.
Yeah.
Enter the barbarians. Specifically, Henry Kravis of KKR Kohlberg Kravis Roberts.
Now, the relationship between Johnson and Kravis adds this whole other layer of personal drama.
Oh, it was incredibly tense. Kravis is the godfather of the LBO. This is his industry. Johnson had actually spoken to Kravis about doing an LBO, but then decided to go with a different partner.
So Kravis feels cut out.
He feels insulted. He feels like Johnson stole his idea. Kravis basically says, this is my franchise. You don't do an LBO of this size without me.
So Kravis doesn't just bid, he launches a nuclear strike. He bids $90 a share.
It shattered Johnson's bid. It blew the doors off the negotiation. Suddenly, Johnson's friendly deal was an all-out war.
And this is where public perception just completely shifts. Up until now, maybe you could see Johnson as a smart guy restructuring a company, but then the details of his management agreement leaked to the press.
This was the greed factor. The leak revealed what Johnson and his small group of executives planned to pay themselves if their deal went through.
It was staggering.
It was obscene. Johnson's group wanted 20% of the profits. They wanted total control. They wanted the company to pay their personal income taxes on the gains.
20% of the upside of a $25 billion company. They would have become billionaires overnight.
When this hit the New York Times, the backlash was instantaneous. Shareholders were furious. The public was disgusted. There were letters to the board calling it armed robbery.
The narrative just flips. Johnson went from being the captain of industry to the symbol of everything wrong with Wall Street.
Yeah, it destroyed his leverage with the board. Even the directors who liked him couldn't support that kind of theft.
So now we have a bidding war. It is just an ego battle. You have Peter Cohen and Ross Johnson on one side and Henry Kravis on the other, and the price just keeps climbing. $90? $100.
It went all the way to $109 per share.
Which leads us to the climax, the final slide. We call it the river of money.
It was the largest corporate takeover in history at that time. The final price tag was $25 billion.
To put that in perspective, that was the size of the GDP of some small countries.
It was an unimaginable amount of debt. And in the end, Henry Kravis and KKR won the bid. They bought the company.
So Ross Johnson lost. He lost his company. He lost his Air Force.
But don't feel too bad for him.
Because of the parachute.
The biggest of all time. Even though he lost the war, his employment contract meant he walked away from the wreckage with $53 million.
He fails upward in the most spectacular way possible. But while Johnson is counting his millions, what happened to the actual company? What happened to the people in Winston-Salem?
That is the tragedy of this story. Winston-Salem was known as the city of reluctant millionaire.
Reluctant millionaire.
Yeah. Many of the locals worked for Reynolds, and they were paid partly in stock. They held on to that stock for generations. It wasn't just an investment. It was their identity. When KKR bought the company, that stock was forcibly converted to cash.
So they got paid.
They got rich. The payout was massive. But they lost their ownership. The company that built their town was now owned by a private equity firm in New York.
And that firm, KKR, now had a $25 billion debt to pay off.
Which meant the era of excess was over. KKR had to strip the company for parts. They sold off Del Monte, they sold off Chungking, they slashed budgets.
The Air Force was grounded.
Grounded and sold. The Taj Mahal hangar was closed. Thousands of jobs were cut. The company was squeezed to wring out every dollar to service those interest payments.
It's almost like a moral correction. The excess of Johnson created the debt of KKR, which forced the austerity of the 90s.
It is a boom and bust cycle condensed into one company.
And there is a final irony here that I love. After all that, after the $25 billion, the drama, the layoffs, what does the company look like today?
Well, years later, after struggling under the debt, Nabisco was sold to Philip Morris and the tobacco unit. It was spun off. It ended up right back where it started, as a standalone tobacco company in Winston-Salem.
So the merger was undone, the LBO was unwound, we are back to square one.
Except for the billions in fees that went to the bankers and lawyers. The only thing the LBO really produced was a massive transfer of wealth from shareholders and employees to the deal makers.
So let's summarize this journey. We went from an unnatural union of cookies and cigarettes to a gold-plated dictatorship under Ross Johnson, and finally to a financial nuclear war that stripped the company bare.
It really is a morality play. It started with a business problem liability stock price, but it was hijacked by ego.
The Ross Johnson factor.
It changed the world. It woke up shareholders. It made boards realize they had to actually watch the CEO. And it legitimized the idea that you can buy a company with debt, fix it, and sell it for a profit. Private equity, as we know, was born in that boardroom battle.
And that leads to the question I want to leave our listeners with. We look back at the 80s, at the gold-plated jets and the antique rubs, and we laugh. We think, wow, they were crazy back then.
But were they?
Exactly. We live in an era of massive corporate debt. We see CEO compensation packages that dwarf what Ross Johnson got. Tech founders have voting control that makes them dictators. Have we really learned the lessons of barbarians at the gate?
Or are we just waiting for the next Air Force to be built? Just maybe with tech stock instead of tobacco money.
That is the $25 billion question. Thanks for diving in with us.
See you next time.